Now that we've talked about the business cycle and predicting recessions, we can turn our attention to GDP, gross domestic product. And in order to build up GDP, we need to do a little bit of accounting and take a look at our second macroeconomic model with a circular flow diagram. So here, the national income and product accounts, or the NIPA accounts as they call it for short, is essentially the way how we calculate out GDP. It's essentially like the balance sheet for any particular country, and it's just telling us exactly how we figure out how much GDP every single country has. And it's actually very useful to have these NIPA accounts because number one, it can help to measure our nation's economic performance over a long period of time. So what happens if our GDP is very, very high? What happens if our GDP is very, very low? And how has that changed over time? Of course, the larger the GDP value, the better off our economy is expected to be. Number two, we can compare US income and output to those of other nations. Because other nations follow a very similar process with their own NIPA accounts, we can compare US GDP against other countries' GDP. So my GDP is bigger than your GDP, my GDP is smaller than your GDP. What exactly does that mean when we compare the countries against one another? And then finally here, it allows to track the economy's condition throughout the business cycle. So here, just taking a look at a bit of a historical standpoint, we can see exactly how the economy is changing from a recession into the trough, into the recovery, into the peak phase. And we can notice exactly what's happening within the economy at every given moment with these NIPA accounts. So let's go ahead and see exactly why we use these NIPA accounts. And there's actually two different reasons or two different approaches to calculating out GDP. We can add up GDP by adding up all the income that's going to be produced within the country, or we can add it up by all of the spending. So there's actually two different versions of the NIPA accounts, and these two different versions can tell us that there are two different approaches to calculating up GDP, focusing on the income approach or on the expenditure approach. And we will spend a lot of time talking about the differences and similarities between these two. But the reason why there's going to be two different ways or approaches to calculating out GDP is going to come through our economic model with the circular flow diagram, which for some reason, ironically, here is a square. But the circular flow diagram tells us exactly how money and how goods and services are going to flow throughout the economy. And just to make this a little bit of a simplified process as we interpret this, we're just going to go ahead and focus in on one particular business, say maybe Target in this instance, and one particular household, so maybe you or I in this particular instance. On the left-hand side, we have the resource market. The resource market is exactly where our factors of production are going to be bought and sold. And then the product market, this is where we actually go ahead and buy and sell goods and services. And as we can see with the flow of these arrows right here, this is going to tell us exactly how goods and services flow or how the flow of money is going to go ahead and go within this particular model. So let's go ahead and take a look at these clockwise arrows first. So here, these inner blue arrows that we see right here. So let's go ahead and start off with you as a household. So you are the individual in this household right here. So what do you provide into the resource market that Target is going to use? So Target needs to utilize you in some way in order to bring out goods and services. So what do you supply? What is the factor of production? You supply your labor into the resource market, and Target is going to sort of exploit or use that labor in order to conduct their business. So you supply your factor of production into the resource market. Target says thank you very much. And by utilizing your labor, they're going to be able to provide goods and services. So whatever Target sells, electronics, groceries, clothing, books. So here, Target utilizes your labors in order to provide goods and services. And who's going to be buying these goods and services in the marketplace? Well, it's going to be you in this household. So here, you supply your labor to Target. Target sells goods and services on the product market, and you are going to buy the goods and services from Target. So essentially here with these clockwise arrows, these blue arrows, this is going to show the flow of goods, services, and input. So here we just want to hit on that fact once again. So clockwise arrows, these clockwise arrows, these are going to show the flow of real goods and items in the marketplace. So here it shows the flow of real goods and items in the marketplace. So real goods, items in the market. So here, real tangible services, goods, and items. On the other hand, we are a little bit interested in how money flows as well. And that's exactly where we go ahead and take a look at these counterclockwise arrows. So this red arrow, the outer arrows that we see in the circular flow diagram. So here, let's go ahead and start with businesses this time. So Target, what exactly do they have to pay us in order for them to get us to work for them? Remember, the specific payment for labor is going to be called wages. So here, Target is going to be paying us wages in the resource market. And we say, thank you very much for our wage. We like to work for money. We like money. And what exactly are we going to be using this money for? Well, we bought goods and services. So here we go to Target. Once again, we go into the product market and say, hey, Target, here's my wage. Here's my money. So please give me goods and services. And that money becomes revenue for Target. So as you can see right here, any wage or any sort of income that we receive in the resource market, we immediately are going to spend it out into the product market, and that goes straight back into the businesses that we have within the circular flow diagram. And that's going to lead us to a very important conclusion where all the income within the economy has to equal all the spending within the economy. So we spend money and that becomes income for us. Or that's going to be, so let's go ahead and rephrase that differently. We get income by working, and then when we get that income, we're going to go ahead and spend that out into the marketplace, into the product market. So essentially here, this is going to be showing us exactly why there are two different approaches to calculating out GDP. We can say all the income that's being accruing to us, or we can go ahead and take a look at all the spending that we're going to be doing. And this circular flow diagram perfectly illustrates this fact. So to go ahead and wrap up this particular sort of circular flow diagram, we just want to go ahead and take a look at these counterclockwise arrows. Counterclockwise arrows. So remember those arrows that we just saw, they depict the flow of money. Shows the flow of money. So exactly where is all of our money going to? Where's all the income? Where's all the spending going and coming from? And based on the circular flow diagram, based on these counterclockwise arrows, we notice that the conclusion that we're going to draw out of this is that all the spending has to equal all the income within the economy. So spending must equal income in economy. It can't be less, it can't be greater, it has to be exactly equal to one another. So all of your income is going to have to be spent out, and all of your money that is spent out has to equal all of your income. And this is going to tell us why there's two different approaches to calculating GDP with this circular flow diagram. In the next video, we'll go ahead and take a look at what GDP actually is, what it entails, and a few of the components that should be included within its calculation.